Good afternoon, everyone. Welcome to our mid-summer quarterly market update to discuss the investment landscape during the second quarter of 2023. Thanks for joining us. While the webinar is, of course, open to guests and the public at large to invite them to explore our unique approach to wealth management, we have curated today's content to be of specific interest to our valued clients at New Outlook Wealth and SKYE Wealth Planning. My name is Michael Van Leerop, and of both New Outlook Wealth and SKYE Wealth Planning. Our two Winnipeg-based financial advisory firms are proud to run this innovative new series of quarterly market updates featuring what we would consider timely, relevant, and hopefully insightful commentary from some of our top investment management partners. Indeed, I'd like to specifically welcome Paul Girard, Portfolio Manager at BCV Asset Management, Brent Smith, Chief Investment Officer of Kinsted Wealth, Eric Benedict, Portfolio Manager at Purpose Investments, and Sheila Wilson-Cole, a Portfolio Manager and Director of Equities Research at Cardinal Capital Management. Thank you all for joining us today. We're in the middle of summer. Weather is pretty intense everywhere across the country, but I have to say that I'm very pleased that not only our presenters are here with us, our panelists are here today, but I want to make special thanks to our clients who decided to join us, and indeed for those who will be watching afterwards once we post this on YouTube. We hope you enjoy it as well. So we'll get right down to business. No fooling around here. We have some quarterly updates to do. I've set aside about 20 minutes to give all four of you your opportunity to share your insights into what's been going on in the markets for the last quarter, how performance has been going for your particular portfolio management style, and also some insights into where you think things are going. So we have some questions, prepared questions for our panel discussion afterwards, but right now we'll do the quarterly updates. And if you want to share screen because you have a presentation or you have slides from a recent slide deck, because I know you all produce quarterly commentary for your clients, then by all means go for it. We'll start with Paul from BCV. Hello, Paul.
Sure. Hello. Good to be with everyone today. By way of quick introduction, so my name is Paul Girard. I'm a CPA originally and a CFA charter holder. I joined BCV last year. Prior to joining BCV, I spent 10 years in the institutional investment management world with an insurance company based here in Winnipeg. I was responsible for the credit investment research function for a $5 billion fixed income portfolio and the portfolio manager for a $300 million Canadian preferred share equity portfolio. And so BCV, just going to share my screen here. So for our advisors and clients that know BCV well, they know well that we're a dividend-focused, value-orientated company. With particular emphasis on dividend-paying companies. Within the fixed income world, we focus on corporate bonds. And so from a performance perspective, from a since inception perspective, performance has been quite strong. And so while prior performance certainly doesn't guarantee future outperformance, our performance has been generated by the dividend focus, the value orientation, and just highlighting the 3-year column here in particular, which sort of encapsulates the COVID experience that we all wish to forget. The performance of or our strategy of value, of dividend focus has generated some pretty meaningful outperformance in that time. On a year-to-date perspective, we've given up a little bit of that performance back, but for in my opinion, for a good reason and actually a quite simple one. And so for a simple reason, I bring up a very, very simple chart. So this blue line here represents the broad S&P or the broad U.S. stock market, and that's relative to the S&P 500 equal weight, which strips out the influence or the dominating influence of your mega cap tech stocks, your Nvidias of the world, your Netflix, reduces the influence of those companies that have been really sort of the main reason as to driving the S&P's, in my opinion, relatively strong outperformance year to date. And so in an environment where those types of stocks are doing well, BCV, just by way of our value orientation, our dividend orientation, won't do as well. But we're quite content with that, and we'll seek to rely on our dividend and our value orientation to hopefully keep driving meaningful long-term outperformance. And so from a broad outlook perspective for the rest of the year, I mean, there's no surprise, and you don't have to look at very many newspapers to see the recession call that many folks have been making and talking about since primarily near the start of the year. But for frankly, in my opinion, some pretty good reasons. But similarly, for also very good reasons, we've seen some relatively robust North American consumers. The broader North American economy's held in pretty, relatively well. For the good reason of, lo and behold, trillions of dollars of stimulus spending over the last 3 years, announced infrastructure spending that we've seen, has resulted in a generally stable and relatively strong North American economy. But you don't have to look far or elsewhere to see that other folks haven't been so lucky. So you look at China, you look at Europe. Those jurisdictions haven't seen as relatively as strong or resilient consumers or economies. That stimulus spending doesn't last forever, and so in my view, the recession fears that everyone's been talking about has been around for a good reason. And lo and behold, if you look from a yield curve perspective, so as a broad indicator of what we could expect going forward, we're actually more inverted now than where we were at the start of the year. And also from a credit spread perspective, and for those that aren't familiar with credit spreads, just you can treat it as a broad generic financial market risk sentiment indicator. And so what I see here is while we're not at crisis wides, we're also not at sort of a trend steady state environment for credit spreads, which just speaks to broad sort of uncertainty. And so what we're taking this all together, what does that mean? I think from a portfolio management perspective, it just means that I think fixed income looks relatively attractive. You're actually getting income from fixed income. And so for client portfolios, I think it's fair and justifiable to have a fixed income allocation that's either equal to or perhaps moderately above their allocation as determined by their policy statements with us here at BCB. From an equity perspective, BCB portfolios are already sort of well suited to what might be perhaps a choppy 3 to 9 month period, just by way of our value orientation, our dividend focus, where in an environment where we don't see a recession, or if we do, if it's a mild one, well, we'll collect our dividends. The companies that we own will grow 3 to 5%. Whereas if we do see a more difficult or stressed environment over the next year, we'll seek to look to sell out perhaps some conservative names that have held up relatively well, and indeed go and buy some names that we have conviction in that are at relatively strong valuations. And so, which is in fact what we've been doing over the last 7 months this year, and what we'll continue to do going forward with BCB. So that's it for my quick update. Looking forward to the panel discussion to get into perhaps more of the macroeconomic environment. Thank you.
Perfect. Thanks, Paul. That was excellent. Some great slides in there too. I did want to mention before we proceed onto onto Brent's is for those attending and watching, by all means, keep your questions for the end. We'll have a Q&A session at the end where you guys can post in the chat or what have you, whatever questions you might have for any one of these awesome portfolio managers. So we'll invite that for afterwards. Brent, I'll pass the baton to you, and let's do a nice little 5-minute overview here.
Yeah, one of the reasons, Mike, I'm not sharing any slides is I can talk for about 45 minutes on what we do. So without the slides, I'll try to keep it to 5 minutes. Just to reemphasize, if you've got new folks listening in on our investment approach, is very different from your traditional type of balanced portfolios, is that we've really embraced the non-public markets. I'd say on average, our average client probably has less than 22-23% public equity exposure. So that'll give you a pretty good idea of how our performance is quarter to quarter. When the public equity markets are surging, we're going to absolutely underperform a traditional type of, if you want to use that as a proxy, we're going to underperform. When markets are tanking, we're going to outperform, because a lot of the investments we have are just not priced on a daily basis. There's a lag effect and so on. So just as context, but from a broad perspective, our equities did underperform, and I'd say that was probably one of the larger reasons for the underperformance of most of our client portfolios. To echo Paul's view, is we've been pretty pretty concerned on the public equity markets going forward, and we can get into this maybe in the next part with some of the questions of why we're saying that. But given our average client has under 20% or 22% public equities, we're obviously didn't participate in the upside there. But outside of public equities, our investments in areas like private credit, which we really continue to like, private infrastructure, private real estate, certain areas of the private real estate have done relatively well. They continue to do well. You're not going to see these up 10, 12, 15% in a quarter, but do we think they're going to do 12-ish, 11 to 12 to 13% longer term? Absolutely, but it doesn't come every single day or every single month. So we're pretty happy with the direction of many of the private stuff. Private equity, venture capital, that's an area that pricing tends to lag by about 6 months to public markets. Last year happened to be one of the worst years for these two asset classes in probably 15 years. So we're still feeling a bit of the effects there. That said, I think that this kind of environment and the next couple of years is going to provide some significant return opportunities in both private equity and private equity secondaries. So we're pretty excited about the future, looking longer term for those asset classes. With that said, I always, whenever I'm talking to clients, not that I talk to clients that often, but I've always said, even going back 4 or 5 years, even when things were doing really, really well, I always say you have to be very, very patient with private markets, especially things like private equity or private infrastructure in certain areas of the private real estate areas, given the timing of returns that you get from these. I would say on average on our portfolios, probably less than 30% of our AUM is priced, or probably closer to 25 is priced on a daily basis. So a lot of it is priced monthly and a lot of it is priced quarterly. So I think if you can understand, our performance that we had for the Q2, we're still waiting on Q2 performance from a lot of our managers. That's just the reality of how these things work. So the correlation between a typical Kinsted portfolio versus a traditional balanced portfolio, there really is no correlation because of the lag effect there. But what are we excited about going forward? I think that we really like a number of areas. Private credit. If you're working with a really, really good private credit manager, yields of, to put this into perspective, a yield of a loan last year, the exact same loan that was yielding 8% is now yielding 13% because of the floating nature of private credit. Yes, if we go into a deep recession, there's going to be concerns there. I think that the jury's still out on how deep it's going to be. We still think there is going to be one, but we're very positive on private credit. Really like private infrastructure. That's an area that we're continuing to increase our exposure to. It's not the easiest thing to increase overnight. You just can't increase that exposure overnight. But actually, I was speaking to one of our managers the other day about the nature with private investments. Let me know if I'm going over time here, Mike. But with private assets, especially with private infrastructure, these managers will invest in an asset and then get it up to where they believe the true value is, and then, as they say in the industry, harvest it or sell it. And I was expecting maybe some of these managers to start selling off some of their holdings over the next couple of years, but one of them said, yeah, actually, we're going to probably start selling over the next year. And I thought, if we actually go into a recession, that's probably not the best time to sell. And their response was that they invest typically in very high cash yielding, very secure government guaranteed contracts. And when they're selling these assets to other like bigger institutions, they really value very strong cash flowing, cash generating assets. So in fact, they believe they'll be able to sell these at a premium if in fact we do go into a recession. So there's a lot of areas that we think, regardless of the economic environment, will continue to do well. Not everything will, of course, but we do have quite a bit of exposure to assets that don't necessarily correlate that strongly to the economic environment.
Cool. Awesome, Brent. Thanks for that.
You bet.
Actually, really on time. So passing the torch to the next one, we have Sheila that'll be talking about what's been going on with Cardinal.
Okay. Well, good afternoon, everybody. Thanks for having me on the panel. So just a reminder for Cardinal, our focus is on public equities. We take a dividend paying, value orientated approach to how we invest in stocks. Just looking at the past quarter, certainly we saw equity markets continue to move up. Things were a bit more muted in the Canadian market with a return just over 1%. So, and as talked about, we saw much stronger growth south of the border with the S&P 500 and the NASDAQ up strongly. A lot of that strength was certainly driven by what's now being called the Magnificent Seven stocks. They drove over half of the year-to-date returns. And when you strip those 7 stocks out and just look at the remaining 493 stocks, the return was 2% year to date. So I think that's just a key thing to keep in mind, that the breadth really wasn't there for the first half of the year. We're seeing that broaden out a little bit more now. So it was less of a factor for the Canadian market. Shopify certainly was a big driver in the second quarter, but given less exposure in Canada to tech, it was less of an impact. And when you go beneath the surface and take a look at the sectors, at least half of them were actually in negative territory for the quarter. It did have an impact in terms of Cardinal's Canadian performance for the second quarter, given in the tech space, there really aren't a lot of companies that meet our criteria for paying a dividend, having consistent earnings growth, and also trading at a reasonable valuation. On the US side, our US mandated did have strong absolute returns. It was up close to 8%, not quite keeping pace with the index, given a lot of those top 7 stocks don't meet a lot of our criteria. But we did have some good dividend paying tech stocks in the portfolio that were help during the quarter, so including Oracle and Applied Materials. So there still are some great options out there if you're looking for dividend paying companies that are also in the tech space. Just talking a little bit in terms of the economy and inflation. It was good to see inflation numbers continue to come down. We saw that through the second quarter, including with the most recent print on the Canadian inflation numbers. So it's coming back within the Bank of Canada's band of kind of that 1% to 3% area. Core inflation certainly remains sticky, and I think it's going to be quite a grind from here on out to get that definitively back down to the 2% area. On the employment side, that's still, looking pretty strong. It's softening a bit, but overall, still seeing some good strength there. And consumer spending has also been good. In part, that's helped by the healthy jobs picture. And then we're still seeing that people have some of those savings that they built up from the pandemic programs. They continue to have that to spend and support the consumer spending part of things. As a result, we do see where we saw the Bank of Canada raise rates by 25 basis points. We're probably going to see the Fed move by a quarter point next week as well. We do wonder if all of the recent raises are ultimately needed, since there is quite a lag between those raises and the impact on slowing down the economy. but it seems like the central banks are really keyed in on reducing inflation, and they are willing to risk a potential recession to tamp that down and make sure that inflation doesn't become ingrained in everyone's expectations.
Yeah.
So going forward for the second half of the year, the focus we feel will remain on inflation, what the trend is, and the interest rates cycles or hikes from the central banks. Market wise, we do expect that broadening of the market participation to continue. We feel there are still, while you might look at the overall market and it does seem rather pricey, especially in the US, when you drill beneath the surface, there still are a lot of sectors trading at reasonable valuations and various stocks. So still advocate for keeping that equity position, and then with our focus on dividend paying stocks, you continue to see that income stream grow over time.
Perfect. That's excellent. Thank you, Sheila. Very good overview, and I like the economic overview as well. It's very much appreciated. We'll touch on that in the panel in a minute as well, because obviously interest rates and inflation continue to be a very strong theme in everything that's going on right now. Derek, on to you.
Thank you. Let me just try to share my screen right here. There you go. Can you see that?
We can.
Awesome. So let's just, first of all, I want to say thanks for having me on the call, and looking forward to talking about the portfolios as well as sort of a macro and market overview. So as we jump into it, I'd say after a not so unexpected start to the year that began with a lot of the most oversold names from 2022 coming in and having a bit of a bounce, the second quarter continued along pretty much the same path, despite a mini banking crisis, the debt ceiling fiasco, and a few other bumps and bruises. The chart in the top left here shows the TSX and the S&P 500, and I think what I want to point out is that once that resistance level of 4,200 broke for the S&P 500, the breakout and the move off after that breakout has really been quite impressive, and the move to 4,500 was very, very quick and pretty strong. But markets are extremely divergent right now. The other chart here on the top right, you have some markets like the NASDAQ in Japan up around 30% year to date, while other markets like the TSX and the Dow they're currently up around 5%. So this is, I think, as of the end of June. So you have this massive divergence between the different markets. And as some other panelists have mentioned, it's been an incredibly thin market year to date. You have the Magnificent Seven driving most of the returns. But it has broadened out over the past month. And I think this other chart here on the bottom right shows this market breadth. So it shows the percentage of members within the S&P 500 above their 50-day moving average, which is, if they're above their 50-day moving average, technically it's means that they're in an uptrend. So it's good to see that this is broadening out and adding legs to the rally. And you sort of need this to become a little bit more constructive on the market. But it's also worth noting that at 80%, if you guess in the close to 90%, this is typically where that breadth number starts to top out. And it's one of the reasons why we do expect a choppy market in the near term, as bulls and bears start to square off and position for the second half of the year. Keys looking forward are going to be inflation. They're going to be central bank policy rates. And I think the biggest key is going to be just how strong can the consumer stay. For now, markets continue to climb the wall of worry. Valuations, especially in the US, I think are pricing in pretty maybe the best case scenario from a macro standpoint. And so moving on, get a little bit into some economic stuff. The data is showing that this looming recession or the pending slowdown, it's now likely later than sooner. So I don't know if anyone can remember, but I think RBC was forecasting a recession in Canada in the first half of this year. That completely did not materialize. So big miss on that call, but they weren't alone. I think that was pretty much a consensus call. Maybe not first half, but certainly at some point this year, or maybe in the middle of the year, you'd start to see a lot more weakness. But the big thing is consumers remain in better shape than most people expected. They've been able to handle the incredible rise in interest rates, and yeah, continue to spend. One of the big things here is like on the housing front, like Canadian data, new housing starts just sort of blew out. It's been increasing. The United States, similar trend, a little bit of a miss today, but I think this move on the housing side just shows that consumers are still willing to pay up and willing to spend at these levels despite increased borrowing costs. Now, from an economic perspective, I think what's most interesting is the separation between services and manufacturing. It's really night and day, and like we call this divergence the K-shape. That's not our thing; it's other people say the thing, but it's true in the economy as well as in the markets. And you know what, manufacturing globally, North America, it does remain in a downtrend, and those economies that are more focused on manufacturing, they're in a tough spot. This is China, this is much as Europe, especially Germany, Italy, and those countries with more of a service tilt within their economy are doing pretty good, and this is the US. And the interesting is like the services, what's happening right now in the services, yes, it's I guess the pandemic hangover from spending and all of that, but it is a bit of an anomaly, so we're gonna have to wait and see how this plays out. But we're having to wait to see sort of where this meets or how this divergence plays out. And interestingly, there is I guess looking back at previous cycles, like there is this long history that you typically get weakness in manufacturing first, and that tends to bleed over into the consumer, into service spending afterwards. So it's not spreading yet. You're seeing service spending starting to slow, but still in expansion territory. So we're going to have to sort of see how this continues to play out in the back half of the year. And from a fundamental standpoint, you know what, most of this market gain, most of the rally right now, it's been on flat to falling earnings, which is concerning. Earnings season's just started, so far pretty decent, but a lot remains to be seen. And I think from the market's point, they really need it. They really need companies to deliver better than expectations. You have high valuations for the S&P 500, much better valuations in Canada and other international markets. But this, especially in the US, like high valuations with a combination of flat to falling earnings. Yeah, it puts markets in a tough spot. And the two charts that I have here showing are sort of EPS expectations for 2023 as well as 2024 for Canada and the US. And the interesting thing here is like earnings expectations this year, or for the most part this year, basically ceased getting worse, but they haven't really improved all that much. But they do, especially in the US, the revisions tend to move the most during earnings season. So we're going to have to see how that plays out. In Canada, it's a little bit different. Like earnings expectations have continued to fall. A lot of that is energy. A lot of that is on the banks. So we're going to have to see how that plays out. From a performance standpoint, the Harness balanced portfolio, so it's a multi-asset portfolio, it's up about 5.2% year to date as of the end of June. Pretty decent, lagging some peers, I'd say, but we've been a little bit more defensively tilted. So I think that's not surprising considering the strength in the overall market. In terms of some recent positions or changes that we've had, we have tilted much more towards fixed income and cash. We're holding more cash than we have historically. Cash positions like high interest savings ETFs are paying over 5%, which, yeah, like you have to go back a long time before you have cash paying that much, which is attractive. But I think what's even more important is the fact that having a little bit of cash on the sidelines right now preserves optionality within your portfolio. It gives you the option to, if you get a bout of volatility, to quickly move in and capture some attractive assets at some attractive prices. So besides adding to cash and fixed income, we've reduced our exposure to credit within the fixed income sleeves. So some of those, like particularly some of those more riskier credit strategies, we've increased duration in our fixed income sleeve. That's sort of a bet that longer term rates are close or near peaking, and should this recession scenario have play out, that rates would actually, you'll see a decline in longer dated bond yields. We've decreased our commodity exposure. One exception is we've increased our exposure to gold. And then within our US allocation, we've moved away from a cap weighted US ETF to an equal weighted ETF, as well as reduce our NASDAQ exposure. So all those moves are sort of in line to reduce our exposure to mainly technology, which we think is being pretty expensive at the moment.
Cool. Very good. Any other things you wanted to add to that, Derek?
No, I
Nope.
think that's it. And let's get our
Good
panel
stuff.
questions going.
Fantastic. Yeah, so I'll get cracking right away, guys. Those were all great and pretty much right on the nose in terms of time. So I appreciate that. Makes it easier for me. So first question I wanted to tackle with you guys. So we've obviously touched on this already, the rate of inflation, right? It's no longer accelerating. Certainly not at this pace that it was. There are signs it's starting to normalize. It came out yesterday that it's actually below, it's within normal ranges again, which is interesting because it seems to have happened really fast. And indeed, if you strip out, if you start looking at things like housing costs, and one of the major reasons why the inflation went down is because energy prices actually dropped significantly. So those are huge spending things for most Canadians. So inflation remains to be a big problem and a big challenge. But given the Bank of Canada continues to raise interest rates, as ostensibly that was the reason to fight inflation, what else aside from fighting inflation is actually going on here? I have my own theories about this, but I'd rather hear what you guys are thinking. So interest rates are going up still, they're creeping up. I think a lot of people thought that this was going to stabilize by now and we were not going to see this anymore. Not anymore, but it certainly would levelize. What's actually going on? So I'll pose that question, that nice, broad, perhaps provocative question. Start with you, Derek, actually. We'll go backwards.
Okay, so I don't think that there's anything nefarious going on with central banks. I think that they're just really focused on bringing it within target. I wouldn't be surprised to see like another rate hike potentially in Canada. I know the US is likely going to hike. You wouldn't be surprised if there is another one. I think from an inflation standpoint, like you do have to keep in mind the base effects of some of the June and July numbers. Like you're going to be lapping peak inflation or peak levels last year. So I think that might artificially depress current readings. And so I think they're trying to looking through and seeing what some of the underlying trends are, digging into the data. Yeah, they're focused, like the banks have two mandates, inflation and jobs market is still incredibly strong. So I think they feel that they can be a little bit tougher to fight inflation because they don't see the jobs market acting as like deteriorating as I think some people would have expected. And I think the other thing is like there are some things within the inflation numbers, like when you're looking at some of the stickier inflation points, it is like they are rolling over, but they are still high. So I think that they are, I think that they're going to go until, maybe not until they break something, but until they see a clear trend within some of this ingrained inflation to bring it down within range.
What about you, Brent? Thoughts? You're muted, Brent.
Sorry about that. You know, you look at the Bank of Canada's mandate, and it's such a vague thing. It's to promote. I wrote this down. Is to promote the economic and financial welfare of Canada. I have no idea what that means, but one of the things it uses obviously is monetary policy. And monetary policy, as I think everyone knows, has a very lagged effect. You know, I'm not sure in Canada, but I know in the US, monetary policy before it kind of flows fully through the economy is anywhere from 18 to 24 months. So I actually, you know, while the Bank of Canada and the Fed may be looking at different things than we're looking at, you know, historically, if you look at central bank policy, they either over tighten or monetary policy becomes too tight or it becomes too loose. And I think interest or inflation has come down, as you mentioned, relatively quickly. And if you kind of look at it and say, well, you know, monetary policy does it has a lagged effect on the economy. You know, you start thinking about, well, once this is fully flows through the economy, is there a potential for inflation to fall even further from where we are? Because ultimately that's the goal is to moderate inflation, get it within that band. But it's hard for me you know, a lot of us have been in this industry a long time, and it's, you know, it used to, and I think I mentioned this last time, everyone says, and I usually focus on the Fed, everyone says, you know, don't fight the Fed, don't fight the Fed. But over the past 30 to 40 years, the don't fight the Fed means, well, the Fed is going to come to the rescue. Well, the Fed or the Bank of Canada are not coming to the rescue. They are tightening. They, you know, while it might not be an implicitly stated objective, I think they are hoping for some kind of a mild recession. So I think it's inflation that they are targeting. I think that they may be getting way ahead of the curve right now, because it's getting close to where they, you know, where they wanted to. But I think that Derek made a good point about the base effect. So it's still to see, you know, over the next couple of months where it comes in. But you know, it's, you got to go with what their stated objective is. I think that they're still trying to rein in inflation, which they've done a pretty darn good job of. But my fear is they're getting way ahead of the curve right now.
Yeah. What about you, Sheila?
Yeah, I would agree with both Brent and Derek. Inflation really is the key focus of the Bank of Canada and the Federal Reserve, and in terms of their recent increases and going back to increasing. So it's and they've telegraphed that they really want to tamp down inflation, and we do feel that they would prefer to run the risk of tipping the economy into a recession, because certainly that would solve a lot of the inflation issues. And versus just perhaps standing pat and seeing how things flow through. Chances are they also will not decrease rates as quickly as the market is factoring in there. They've certainly telegraphed that in their comments, that they will, once they do ultimately reach the peak, they will keep rates at that level for a while. But I think that stands to be seen. If we do see the economy tip into a recession, they might
They might change their story
sooner than expected, or at least sooner than they are telegraphing.
Paul, what are your thoughts on this situation?
Yeah, sure. I think in the original conversations, the 5 minutes each where Sheila noted, inflation expectations are really what they're targeting. I'd agree with that. Despite what central banks will have you believe, they don't influence most interest rates. What I try to tell clients is to remind themselves that, the yield curve is dynamic, and it goes from a 3-month period to a 30-year period. And central banks typically only influence the 1 to 2 year part of the curve. And what drives everything beyond that? Well, that's economic growth, in actual inflation, and of course inflation expectations. So I think that's what they're targeting. And then just from an overall picture, from a yield inflation perspective, again, look at the yield curve. The bond market is trying to tell them that, hey, you're not going to get much. You're not going to stay at the 5.5% level. Eventually, they'll have to cut, whether it's in a year or 2 years' time. That's what the bond market's telling them. Someone's going to be correct. Either the Bank of Canada will be more correct, or the broader bond market will be more correct. But either way, I mean, it's going to land somewhere in that 3 to 3.5% sort of range on a more steady state perspective, which sort of just feels right. Like if you think of where the economy was, where interest rates were prior to the pandemic. So if that means a 5-year rate of, say, 2.5% on average, let's say. Well, with all the dynamics we've seen with onshoring and friendshoring and supply chain management and everything, that costs something. Maybe that costs 50 basis points. Maybe that costs 100 basis points. Well, if you add that to what the steady state 5-year was, you get to that 3 to 3.5% level, which is, lo and behold, exactly where the bond market is sort of telling you where to go. So in conclusion, 1, I think, yes, they're targeting inflation expectations. 2, I think they eventually cut. It's just a matter of when and how fast. And the 3 to 3.5% yield level for everything 3 years out sort of just feels right to me.
So actually, I just have an extra thing to add to that and see what you guys are thinking about this, because one of the things that doesn't seem to be coming up at all in these conversations, it seems to be focused on inflation. But what about the currency? And I bring this up because obviously we as a country import a hell of a lot of stuff. Major, most people buy their food, most of which is being imported from the US or elsewhere. So the Canadian dollar's value has a huge impact on a whole whack of things. And a weaker dollar increases the price of everything we buy at the grocery store. So I'm just throwing it out there, like, is it possible that part of this is being driven not just about inflation, but also about keeping the dollar from tanking further or weakening further, because that would just exacerbate inflation even more? Anybody?
Yeah, perhaps. I mean, central banks do have a history of soft talking the dollar, up or down in either direction. But I mean, frankly, from our perspective, we looked at Canadian dollar relative to the US dollar at times. But if I could accurately predict where FX rates are going, I'd be running a hedge fund in New York and not weathering the winters here in Winnipeg. So that's all I have from an FX perspective.
That's fair.
Yeah, I don't, Mike, I don't think that they actively target a range for the CAD. But you're right. I mean, if
You think they don't?
What's that?
You think they don't?
No, I don't think I think that they preferred it into a certain range. Obviously, if it goes down too much, the exact same, the thing that you just talked about, it actually is inflationary, right?
It's hugely inflationary.
And the worst case would be the US. The US, it's 70% of their economy is the consumer. And the US imports so much goods.
Yeah.
That it, if their currency tanks, it has an incredibly inflationary impact. So yeah, currencies do have could have a major impact depending on but then the more expensive your currency is, yeah, it's deflationary, but it makes you less competitive as well. So it's a balancing act.
For sure. For sure. I was just wondering, like, I don't, off the top of my head, I don't know what the spread is between, if there is even a spread between the Canadian Central Bank and the Federal Reserve right now, but I could certainly see if they're raising rates, we have very little choice but to continue to raise rates as well. I guess that's kind of what I'm getting at.
I think, yeah, they do move. They do move in step with each other, but I don't necessarily think, I think it's just part of it is the fact that, like, they're going through the inflation aspect right now. We are as well. Like, our economies are so intertwined that typically it's like what one country is experiencing, the other one is also experiencing. I don't think with the Canadian dollar, say, like, was it mid-70s right now? It's not really, like, central banks, if they're going to get involved in the currency market, it would be when a currency is at an extreme. And I don't think that's it. We're at an extreme, even in the low 70s. I don't think that's an extreme level where they would be interested in actively coming in and try to manipulate the currency market, to be honest.
Gotcha.
Yeah, I would just sort of echo a lot of the comments that it's more what's happening within the Canadian economy driving their ultimate decision in terms of interest rate hikes. And we've seen quite a flow into the US dollar as a safe haven the last couple of years, really. So perhaps we see that reverse, but it's so difficult to predict where the currency ultimately goes. As we often say, it's probably one of the most difficult things to forecast in terms of the financial markets.
Yeah, no, definitely. And I think it does have sometimes an outsized impact on the cost of living, right? So it's just something that I thought would be interesting to discuss. We're actually running right up against the time. I wanted to keep it to 45 minutes today, guys, because I think it's a nice tight package, and people can watch this afterwards on YouTube, and I know they won't fall asleep. This is fascinating, and next time we'll make sure we put some provocative questions so that you guys can actually, like, debate something. That'll be exciting.
I think we're all too Canadian to actually, like.
Yeah, no kidding.
Right?
No, this is fantastic. I appreciate everybody. I don't see any questions from our audience, which is perfectly fine. But obviously, if they're clients, they know exactly who to go to get any questions or concerns addressed. And for everyone else, I thank you for joining today, and hope everybody enjoys the rest of the summer. And we'll see you all on our next one, which will be next one of these, which will be in October 19th. Will be our next quarterly update. So thanks again, Paul, Derek, Brent, and Sheila. That was lovely, and we'll see you all again soon.
Okay.
Take care.
Thank you.
Bye.
Thanks very much.